Market resilience and economic prosperity will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is entitled Examining Monetary Policy and Economic Opportunity. Without objection, all members will have 5 legislative days in which to submit extraneous material to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Welcome to the first hearing of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity. Our task force is charged with examining issues related to monetary policy, the Federal Reserve Act, and how economic growth and price stability affect the financial well-being of all Americans, all of which we'll discuss today. The task force will also focus on the fundamental role that the U.S. Treasury debt plays in our economy and the resilience of the Treasury market. It's impossible to overstate the importance of a healthy Treasury market, and will pay special attention to the recent stresses the market has faced and how to increase liquidity and stability for the market and its participants. But today, we'll focus on monetary policy, how the Fed controls the money supply and interest rates, and why it matters to everyone in this country. The Fed uses interest rates, its open market operations, its reserve requirements, a whole host of policy tools to stimulate the economy or to cool it down. While our constituents may not monitor the actions of the Fed on a daily basis, they all feel the squeeze when inflation runs rampant and their dollar doesn't go as far at the grocery store or at the gas pump. That's why it's important that the Fed gets it right. Since the first central bank in 1791 to the Federal Reserve System we have today, the bank has evolved as the country has. 3 recent changes are worthy of focus today. First, the Fed's move to the ample reserves regime forced the Fed to use administered rates rather than the supply of bank reserves to steer policy. Second, the growth of the Fed's balance sheet. The 4 rounds of quantitative easing over the past 20 years have expanded the Fed's balance sheet, peaking at nearly $9 trillion in 2022. We'll hear about this today as the Fed now engages in quantitative tightening. Third, the Fed's move in 2020 to their flexible average inflation targeting strategy, or FAIT. This strategy tolerates high inflation after periods of low inflation. I hope to discuss the effectiveness of this strategy considering the stubbornly high inflation we've dealt with since FAIT was announced. Finally, Dodd-Frank's considerable expansion of the Fed's regulatory and supervisory authority has exposed the Fed to more political pressures, threatening its monetary policy independence. The Fed enjoys broad independence in its implementation of monetary policy, but it is not unaccountable to Congress for its actions, particularly as we see the remarkable changes I've described. Our conversation today will be insightful to the Fed as it's wrapping up its 5-year review of this framework. The Federal Reserve System is an ongoing project. Congress's attention to this work is crucial as we know the actions of the Fed indirectly impact the economic well-being of all Americans. I want to thank Chairman Hill for creating this task force and Ranking Member Vargas for leading with me, and I look forward to our work together. With that, I yield back. The chair now recognizes the ranking member of the subcommittee, Mr. Vargas of California, for 4 minutes for an opening statement.
Good morning, Mr. Chairman, and thank you very much for introducing me. And again, good morning to everybody else. Let me congratulate you on being named as chairman of this task force. As you know, I have a great deal of respect for you. When I first came to Congress 13 years ago, I was on the Agriculture Committee, which you chaired, and I thought that you treated everyone even-handedly, straightforward, and honestly, and I appreciate that. And I look forward to working with you and together on issues where we find common ground. Through this task force, I look forward to discussing important issues that affect our constituents in the entire economy, including the Federal Reserve's monetary policy framework review and the supplemental leverage ratio, and the debate between rule-based and discretionary monetary policy. But I also plan to defend my core principles, and I know you will. 2 of those core principles are my belief in the importance of the Fed's dual mandate and the need to protect the Fed's independence. The importance first of the dual mandate. As member of this task force, We're well aware that the Fed's dual mandate was established in 1977. The amendments to the Federal Reserve Act passed that year tasked the Fed with two important goals: to create economic conditions that achieve both maximum employment and stable prices. The inclusion of employment was no accident. The addition was thanks to in large part to the work of Coretta Scott King and many in the labor movement. Some have argued that the Fed's reserve dual mandate has been a distraction from solely focusing on price stability. But maximum employment should not be on the chopping block. When Congress charged the Fed with this dual mandate, it recognized that having access to a job is a signal of a healthy economy. Preventing the Fed from addressing employment would misunderstand the key way that many Americans experience the economy, and it would also disproportionately hurt working class people. Low employment harms Americans who are already living on the edge, working multiple jobs and surviving paycheck to paycheck. Chairman Powell has said that the dual mandate has, quote, served us well, and that he, quote, doesn't see the case, unquote, to move forward with a single mandate of price stability. And I agree. As a ranking member, I intend to continue to advocate for the importance of preserving the Fed's dual mandate. Now, with respect to the independence of the Fed, another area where the Fed has come under increased scrutiny is its independence. The research is clear that the central banks around the world function at their best when they're allowed to operate independently. Elected officials mostly operate on a short-term horizon, responding to short-term political incentives. But the Fed must make decisions considering a much longer time horizon. That is why it is critical that monetary policy be insulated from external political pressure. The President's recent executive order requiring independent agencies to submit proposed regulatory actions, strategic plans, and priorities to the White House for review only makes this issue more important. And it's also worrisome that now Treasury Secretary Scott Bessent has floated the idea of creating a shadow Fed chair before Chairman Powell's term expires in May of 2026. We in Congress, regardless of political party, must continue to strongly defend the independence of the Fed. The new administration has brought in a wave of uncertainty. Whether it's tariffs or the future independence of the Fed, our constituents are increasingly unsure of their economic future. We see it in recent national consumer sentiment numbers, which have shown that consumer confidence fell by 7 points in the most recent Conference Board's Consumer Confidence Survey. And I'm hearing from businesses in my district in San Diego who are increasingly concerned about the impact that tariffs and trade wars will have on the economy. I hope that this task force will provide a forum for substantive debate and collaboration on these issues that impact our constituents. I'm looking forward to it, and with that, I yield back, Mr. Chair.
Gentleman yields back, and the chair appreciates the very thoughtful discussion. With that, the chair now recognizes the chairman of the full committee, Mr. Hill, for a minute.
Thank you, Chairman Lucas. The Federal Reserve's dominance affects everyday family, business, and worker decisions in our country. And those Fed decisions, whether it's the cost of a mortgage or the return on savings or the stability of economy, plays a central role. Many Americans weren't alive during the 1970s or early 1980s, quickly learned just how devastating inflation can be at the pump or at the grocery store with this 40-year record high inflation under President Biden. That's why the new Monetary Policy Task Force, led by Chairman Lucas, is holding its first hearing to examine how monetary policy shapes economic opportunity and what that means for the future of American prosperity. To begin this work, we must first establish a solid foundation. Today will be a level set for our members so that we can do deeper dives during this Congress. We'll start with the fundamentals, including the Fed's monetary policy tools, decision-making, balance sheet policy, and U.S. Treasury markets. And we'll hear how these policies have real consequences for investment, wages, and even the federal debt, where rising debt levels and interest costs pose a growing risk to our fiscal health. I look forward to our witnesses' testimony today, and I yield back, Mr. Chairman.
Gentleman yields back. The chair now today welcomes the testimony of Mr. Donald Kohn, who is currently a senior fellow at the Economic Studies at the Brookings Institute. He spent 40 years at the Federal Reserve System, serving previously as vice chairman of the Board of Governors. Mr. Joseph Wang is currently the Chief Investment Officer at the Monetary Macro LLC, a registered investment advisor from 2016 to 2021. He was a senior trade on the open market desk of the Federal Reserve Bank of New York. And Norbert J. Michel is currently the Vice President and Director of Cato Institute's Center for Monetary and Financial Alternatives. And Michael Konzel is the Senior Director of Policy and Research for the Economic Security Project. We thank each of you for taking the time to be here, and each of you will be recognized for 5 minutes to give an oral presentation of your testimony. And without objection, your written statements will be made a part of the record. Dr. Kohn, you are now recognized for 5 minutes for your oral comments.
Thank you, Mr. Chairman. It's a pleasure to be back in front of this committee. Mr. Hill told me I hadn't aged a day in the 10 years since I was last here. I sometimes don't feel that way, but it's nice. Thank you for the compliment. This task force should enhance Congress's ability to oversee monetary policy. Congress has set goals for the Federal Reserve and the conduct of policy, maximum employment.
Would the gentleman redirect his microphone a little more in the direct, please?
Okay. All right.
Thank you.
Congress has set goals for the Federal Reserve and the conduct of policy, the dual mandate, maximum employment, stable prices, but it has also very wisely allowed the Fed to determine the best policies to meet those goals without direct interference from the political process. That's because history shows that political pressures are invariably on one side for lower interest rates, which people facing elections see as boosting jobs. But giving in to those pressures results subsequently in costly inflation. With a high degree of policy independence, however, comes responsibility of the Federal Reserve to clearly explain what it is doing and why, and of the Congress to examine those explanations. Your staff suggested that I might be helpful in this regard by giving an overview of how monetary policy works. The path from policy choices on Constitution Avenue to prosperity on Main Street is a long and winding one. Policy decisions start by asking how the economy is likely to evolve over coming quarters relative to these goals, and if it is not likely to achieve the goals soon, how policy should be altered. Since 2012, the Fed's Federal Open Market Committee has issued a statement on longer-run goals and monetary policy strategy that defines the goals and gives some very general thoughts on the approach to achieving them. In 2020, in response to a prolonged period of very low interest rates and persistent shortfalls of inflation, the Fed altered its strategy. The intention was mainly to make sure that inflation was high enough to average 2% over time, which in turn would keep interest rates high enough to give the Fed sufficient room to lower interest rates should an adverse shock hit the economy. Obviously, the post-COVID recovery presented the Fed with a very different environment, and it is now reviewing its statement. Its strategy must be robust to a variety of shocks and stresses. Adjusting an overnight interest rate is the main instrument the Fed uses to make progress towards the goals. That rate does not directly affect prices or employment. Rather, it works by influencing prices in financial markets, which in turn induce changes in spending and the balance of aggregate demand and aggregate supply. Note how indirect this process is. Mr. Chairman, you used the term indirect, and that's exactly right. The effects of a policy on objectives will depend on how financial markets react to actual and expected policy, and then how households and businesses respond to changes in financial markets. Moreover, financial conditions and the balance of aggregate supply and demand are affected by many things in addition to monetary policy. In considering these shocks to financial conditions in the economy, the Fed needs to differentiate between those that happen on the demand side of the economy and those that happen on the supply side of the economy. Monetary policy is well suited to offsetting demand-side shocks, but it cannot offset an adverse supply shock. The rise in the price of a good, say from a reduction in supply as we experienced in the 1970s in petroleum markets, or an increase in taxes on that good. Advice for policymakers in this situation is to avoid trying to offset these effects, because trying to might actually worsen the outcomes, but policymakers need to be very attentive to the second round effects, the follow-on effects of these initial supply shocks. Expectations of prices and interest rates have played a critical role in our story. Expectations anchored around the Fed's target of 2% are necessary to achieve that target, and expectations about future policy have important effects on financial conditions and hence on achieving objectives. The better people understand Fed policy and intentions, the more stabilizing market responses to policy and to unexpected economic developments are likely to be. That's why the Fed has become much more transparent over time about why it is making its decisions and its outlook. I hope my testimony has provided a framework for discussing monetary policy, and I'm happy to take your questions.
Thank you, Dr. Kohn. Mr. Wang, you're now recognized for 5 minutes for your oral remarks.
Good morning, Chairman Lucas, Ranking Member Vargas, members of the committee. Thank you for inviting me. I appreciate the opportunity to testify today. My name is Joseph Wang, and my work focuses on understanding the transmission and impact of monetary policy. The ultimate effect of monetary policy depends on many variables outside of the Fed's control, so setting policy is a difficult job whose success rests upon good judgment. The significant discretion accorded to the Fed makes oversight especially important, but the complexity of the subject makes its actions difficult to evaluate. An understanding of the tools within the Fed's grasp and corresponding trade-offs in their use can be helpful in that regard. But before discussing their tools, I will note the Fed's significant influence over the economy stems in part from the ambiguity within their dual mandate of price stability and full employment. While price stability is a mandate given by Congress, the current 2% inflation target was decided by the Fed itself. The level of unemployment rate considered to be full employment is also decided by the Fed itself. Where they decide to set these goalposts have wide-ranging impacts on everyday people. Generally speaking, the two mandates call for conflicting policy prescriptions. The balance between the two mandates is a judgment left to the Fed, as is the appropriate timeline to meet their goals. The Fed's discretions to set its own goals, to balance these goals, and to set timelines to achieve them makes oversight difficult. Moving on to the Federal Reserve's tools, the Fed's primary monetary policy tools are interest rates and balance sheet policy. Regulatory policy is an additional tool that does not explicitly target monetary policy goals, but also has significant impact on the economy and financial markets. The reliance on interest rate policy means that the economic impacts of monetary policy are primarily through interest rate-sensitive sectors. Typically, higher interest rates would dampen economic activity in sectors like housing and autos, as buyers in those sectors tend to finance their purchases. This lays the brunt of economic adjustments onto blue-collar workers. Note that the overall economy's interest rate sensitivity also varies over time, where an asset-light, services-focused economy tends to be less interest rate sensitive. Interest rates also impact economic activity through the wealth effect, where higher rates lower the price of financial assets and thus the spending power of households. Asset holdings are concentrated in a small percentage of the population, but that group has an outsized impact on economic activity. One last note on interest rate policy is its impact on fiscal policy. As the level of the public debt has risen, so has the level of interest rate payments. Interest rate expenditures now exceed $1 trillion a year, in part due to the level of interest rates. An increasingly important side effect of Fed actions is its impact on the nation's budget. The Fed's secondary tool is its balance sheet, which can influence interest rates and also allocate credit. The Fed can create money out of thin air and lend directly to borrowers or indirectly through purchases of debt. This is essential to performing its lender of last resort function. Fed purchases of securities are limited to a very small subset of assets that include mortgage-backed securities, which is in effect allocating credit to home buyers. Most recently, it was deployed during the pandemic, where hundreds of billions of dollars worth of mortgages were purchased even as home prices nationally surged by 20% in a year. The distributional consequences of those actions look to last many years. Regulatory policy is less visible, but also an influential part of the Fed's toolkit. Regulatory policy places constraints and costs on the actions of banks. More stringent regulation reduces the willingness of banks to take risk and results in a stronger banking system. However, a more constrained banking system also limits the supply of credit to the public. Small and medium-sized businesses are more heavily reliant upon banks for financing, while larger businesses tend to borrow directly from the capital markets. More stringent regulation also impacts the functioning of treasury markets and the level of interest rates. Regulations like the supplementary leverage ratio contributed to the strength of the banking sector through the pandemic, but also the malfunction of the treasury market at that time. In summary, the Federal Reserve has large latitude in setting its own goals and exercising a range of tools towards achieving those goals. How those goals are set and which tools are used have large impacts on the lives of the American people. This makes the task of overseeing the activities of the Fed both very important and difficult. I thank Chairman Lucas and Chairman French for their wisdom in establishing this task force to improve the performance of monetary policy towards greater economic prosperity.
Thank you, Mr. Wang. Dr. Michelle, you're now recognized for 5 minutes for your oral remarks.
Good morning, Chairman Lucas, Ranking Member Vargas, members of the committee. Thank you for the opportunity to testify at today's hearing. My name is Norbert Michel. I'm Vice President and Director for the Center for Monetary and Financial Alternatives at the Cato Institute. But the views that I express today are my own and should not be construed as representing any official position of the Cato Institute. In my testimony today, I argue that Congress has given the Fed too much to do and too much discretionary authority to carry out those mandates. To secure the best outcomes for the typical American, Congress should give the Fed less to do with less discretionary authority. The engine that drives prosperity for Americans is private enterprise, and the Fed should carry out its core function, supplying the economy's base money, by interfering as little as possible with that engine. It should ensure that it does not become the source of monetary-induced slowdowns or inflation, and it should remain transparent and directly accountable through elected officials, goals that can be best accomplished with a monetary policy rule. And I'll make 3 main points in support of my position. First, stable prices should not be equated with 2% inflation every year. Optimally, the rate of inflation would vary with the nation's productivity, sometimes gently rising, sometimes gently falling. By targeting an always positive rate of inflation, even as productivity improves, monetary policy has been biased toward expansion, and that has hurt Americans by preventing them from enjoying the full benefits of a growing economy. Through much of the past several decades, the price level should have fallen gently, but it hasn't, meaning that Americans have experienced an unnecessarily high cost of living. Second, as the recent inflationary episode clearly demonstrates, Americans hate inflation, as I'm sure I don't need to tell you. They understand that it lowers real income and that it reduces their real returns to savings. They also understand that the Fed cannot simply flip a switch and stop inflation once it takes off, and that expansionary fiscal policy makes the Fed's job even harder. They do get it. They don't want to hear that over time, nominal incomes tend to rise, offsetting inflation. They don't want to wait, and they don't want high inflation. They know that it increases their cost of living, and that's what they care about. But increasing inflation is only one side of the monetary policy coin. If the Fed mishandles monetary policy, it can also lead to an economic slowdown, one where output, employment, and income falls as the economy shrinks. During the past few decades, we've been spoiled and not had to endure many of those types of monetary-induced slowdowns, but the potential is there and must be considered during any efforts to reform the Fed and improve monetary policy. Together, those types of slowdowns and inflation are examples of why congressional oversight of the Fed is so important and why it is critical that Americans are given the opportunity to hold both Congress and the unelected officials at the Fed accountable. Finally, the Fed should not be expected to fine-tune or manage the economy to hit precise macroeconomic targets, much less precisely improve micro-level metrics for certain groups of Americans. Monetary policy is a very blunt tool, one that works in conjunction with fiscal policy. And providing funds, whether through loans or grants, to specific groups or companies, financial or otherwise, is not an appropriate role for a central bank in a representative democracy. If Congress wants to provide loans to, just for example, municipal governments, then it can appropriate the money and do so in a transparent manner so that voters can either approve or disapprove of those actions taken by their elected representatives. So in closing, I'm arguing that Congress has given the Fed too much to do and that it's hard enough to get monetary policy right in the first place. Many of these other tasks given to the Fed have only exacerbated that problem. Thank you for your consideration, and I'm happy to answer any questions you may have.
Thank you, Doctor. Mr. Konzel, you are now recognized for 5 minutes for your oral remarks.
Thank you. Chairman Lucas, Ranking Member Vargas, and distinguished members of the task force. Thank you for inviting me to testify. My name is Mike Konzel, and I'm the Senior Director of Policy and Research at the Economic Security Project, where we advocate for ideas that build economic power for all Americans. Previously, I was a Special Assistant to the President and Chief Economist at the National Economic Council under President Biden, where I specialized in macroeconomic issues. I applaud this task force for investigating central bank independence and the dual mandate. Despite the challenges after COVID, the U.S. economy performed better than many peers, and by late last year, we were on a solid footing. The balance between full employment and price stability, free from short-term political pressures, has worked well for us. I want to make 3 key points here today. First, the Federal Reserve helped the U.S. avoid a recession after the inflationary shocks caused by COVID and the war in Ukraine, achieving a rare soft landing. Second, this achievement is now at risk due to current administration policies. And third, the key macroeconomic decision this year will revolve about whether or not Congress worsens the debt and deficit, which will put pressure on the Federal Reserve, interest rates, and everyday families. First, there is a growing consensus that the global wave of inflation following the reopening was driven by rapid shifts in the composition of demand and shocks to supply chains and key inputs like semiconductors, made far worse when global commodity markets went into chaos following Russia's unprovoked invasion of Ukraine. As Ben Bernanke, the former Federal Reserve Chair and Chairman of President George W. Bush's Council of Economic Advisors recently said, quote, "I think that the inflation was caused pretty much by the supply side, and that the demand factors were not strong enough," end quote. Professional forecasters in financial markets did not predict this inflation, which was in fact global. Other countries saw inflation in the same range as the United States, even countries like Canada and Australia that had less direct exposure to Russian energy, though all of their growth lagged our own. Many thought that this inflation was driven by excess demand and spending, and thus we'd need a recession, higher unemployment, and slower demand growth for inflation to decline. But inflation fell 6 percentage points as growth took off at an annualized 2.9% over the past 2 years, well above the average of the 21st century. Now, for people, for the Federal Reserve and others, this strong economy now faces 3 immediate macroeconomic risks from the, frankly, irresponsible policies of this current administration. Unexpected tariffs, weakened state capacity, and pressures on Federal Reserve independence. Publicly announcing high tariffs outside formal processes in an inconsistent and confusing manner not only weakens an investment, but risks inflation expectations. Normally, tariffs are small, strategic, and have little effect on aggregate prices. However, the tariffs currently under discussion are significantly higher and broader than anything in recent history. And already the University of Michigan survey found inflation expectations peaking in February to levels not seen since 1995, and certainly was not hit as inflation expectations were managed under the Biden administration. This is exacerbated by attacks on state capacity. Cutting government waste and fraud is important, and Congress's own research services have found many ways in which that can be done. But this is not what is happening right now. This will raise prices and costs for everyday families, whether or not it's weakened consumer financial protections, poor Social Security services, or the inability to contain bird flu. We also dealt with avian flu outbreaks in the Biden administration, but we were able to work with government agencies, such as USDA, to contain it. Instead, now communications are altered for ideological reasons, and severe cuts at USDA include those tasked with managing bird flus. Egg prices now exceed the peak seen during the commodity market turmoil and avian flu outbreaks under the Biden administration. But the most important, and I think the thing the task force is most important you engage with, is the removal of central bank independence. Though the executive order removing independence currently says that Federal Reserve monetary policy is exempted, I believe that that is an unstable arrangement, as the politicization of other Federal Reserve functions and personnel will seep into monetary policy and central bank policy. Nothing could destabilize an economy faster. The president sought to influence central bank actions during his first term. The threat of him doing so again would risk the overall economy and the stability premium that we have as a nation. Nothing this task force will discuss will matter for the long-term stability of macroeconomic conditions as much as stopping this effort. Third and last, the most important immediate determinant for macroeconomics this year will come from fiscal policy, in particular how Congress handles the expiration of the TCJA. Right now, we are seeing that nonpartisan estimates have the current bill under discussion increasing that primary deficit the deficit to 6.8%, a rate far higher given the near full employment we currently have. Worse, this exploding deficit will be used as justification for painful cuts to healthcare and social insurances and weakening some of the few countercyclical programs we have if a recession happens. The overall plan of tariffs and spending cuts creates a potential cruel double whammy where the proposed tariff packages could skyrocket the cost for everyday goods, coupled with cuts for critical services. Meanwhile, corporations getting these tax breaks can simply pass their costs on to consumers. The Federal Reserve is left with a very difficult decision about how it manages the subsequent price hikes. I look forward to taking your questions.
Gentleman yields back. The chair now recognizes the gentlewoman from California, the ranking member of the full committee, Ms. Waters, for 1 minute.
Thank you very much, Mr. Chairman. I thought we were going to talk about capital formation today rather than monetary policy. If we really want to discuss the cost of living, we should discuss President Trump's policies that have left working-class families bracing for disaster. Just yesterday, Trump announced massive new import taxes on Americans and American businesses, buying things from Canada and Mexico. Last week, Republicans voted to advance Trump's budget and cut up to $880 billion in Medicaid funding, which could eliminate coverage for nearly 16 million people. Experts have said that Chairman Hill's district alone would lose $2.3 billion in funding for more than 180,000 of his constituents covered by Medicaid and other programs. We should reject these misguided policies that are raising the cost of living for most families while Elon Musk and billionaire class push for their taxes to be cut. Thank you, and I yield back the balance of my time.
Gentlelady yields back. We'll now turn to member questions. The chair now recognizes himself for 5 minutes for questions. Dr. Kohn, you spoke in your testimony about Fed independence. We know an independent central bank is important in making sure that monetary policy is not subject to the whims of partisan politics. That does not mean that the Fed can't or shouldn't be held accountable to Congress and the public. Can you talk more about the limitations of Fed independence, where it's important for Congress to exercise its constitutional authority to conduct oversight?
Absolutely, Mr. Chairman. I agree with what you said. So I think the Fed has an arm's length relationship with the political system. It makes the decisions on the setting of its policies in order to achieve the goals that you gave it. And it is accountable to the public and to you. So you need to press it. Why did you make that decision? Why was it this way? How is that going to further your goals? I think the Federal Reserve benefits from good, focused questioning from the Congress.
Switching subjects, Dr. Kohn. In the past 2 decades, the Fed has moved to the ample reserves regime, and since then, we've seen a dramatic increase in the size of the Fed's balance sheet, stressing dramatic. In 2022, the Fed began quantitative tightening and has decreased the size of its balance sheet. Chair Powell has said that the Fed will stop QT when reserve balances are somewhat above the level judged to be consistent with ample reserves. Where should the Fed look to target its balance sheet size? Is there an ideal level of reserves they should aim for?
So I think what they're aiming for is, as Chair Powell said, is to reduce its balance sheet until reserves are just large enough to stabilize market interest rates. And it is looking very carefully at those market interest rates to see whether it's gotten down that far or not. And so far, the market rates have been stable. There's no sense of instability, so it's continuing to reduce its balance sheet. I think that's fine. I don't see it as a big deal as to whether reserves are 2 trillion or 1 trillion. I mean, the Fed has government securities on one side of its balance sheet. It issues reserves to the banks on the other side of the balance sheet. I think the ample reserves regime should work just fine to control interest rates, and that's what you need it to do.
Mr. Wang, you include in your written testimony a discussion of the supplemental leverage ratio and the Fed's regulatory relief during the pandemic. You write that the Fed's current regulations on the SLR incentivize low-risk activities like holding treasuries. Given the stress we've seen in the treasury market, do you think the Fed should reevaluate the SLR?
Thank you for your question, Chairman Lucas. And I absolutely agree. So the SLR is basically a regulation that makes banks hold capital based on the size of the balance sheet without regard to the riskiness of their assets. Now, when you're looking at assets, for example, like reserves, which are very liquid, have zero credit risk, or treasury securities that have no credit risk and very liquid, it does not make sense to have to hold capital against those. And looking across the world, there are also other countries who have regulations that don't require reserves in the SLR. So I think some adjustment there would significantly increase the capacity of the banking system and improve the functioning of the treasury market.
Dr. Kohn, back to you for just a moment in the time I have remaining. There have been many significant developments in our economy, the market conditions, the Fed's implementation of monetary policy these last 5 years. What are the issues you think the Fed should pay attention to during this framework review?
Was that
Dr. Kohn.
So I think it should pay attention. It said it's going to look at the strategy, so I think it should look at what it did in 2020, assess whether that contributed to a delay in responding to inflation, and then change. So I think it needs the 2020 framework review stressed the strategy was, what do I do to counter the low interest rate, low inflation environment that 2010 to 2019 put it. Remember, interest rates are zero for a lot of this. And it didn't think about a high inflation environment. So they need to have a strategy that's robust to all kinds of different outcomes. And the minutes of their last meeting suggest that's what they're trying to do. They're trying to modify that framework.
Thank you. My time's expired. The chair now recognizes the ranking member of the task force, Mr. Vargas, for 5 minutes for questions.
Thank you very much, Mr. Chairman. And again, I want to thank all the witnesses here today. Appreciate it. It's interesting that we seem to have an uneasy agreement with the independence of the Fed. I mean, I was curious to see that the first question that the chairman asked was the limitations that the Fed has in their independence. And Mr. Kohn, the question was directed to you, and you gave a very interesting answer. I would ask Mr. Konzel, I mean, it is interesting that we seem to agree on the independence of the Fed, and then very quickly we go to limitations of the Fed. Could you speak a little bit more, because you said that this is probably the most important issue that we'll talk about on this task force. Could you go a little more into depth about that? Because I think that, again, with the dual mandate and the independence, those are the two most important things that we should focus on in this task force. Go ahead, sir.
Yeah, absolutely. So, accountability is quite important, and Congress obviously sets the goals for the central bank as, legislative bodies across the world set the goals for their central banks. And then, there's reporting back. Obviously, Chair Powell and other Federal Reserve chairs have come and, talked to Congress twice a year. There's a lot of transparency in the way that they're talking about their actions, how they're carrying them out. I actually feel that there's a lot of public accountability with media and so forth on their actions as well. What I would worry about is executive control of their day-to-day functions, excessive control about the way in which they're conducting, in the way that they are prioritizing and balancing their different priorities in ways that reflect short-term political gains but may have long-term economic costs.
Well, I mean, one of the
Can I pick up
Yeah, sure.
a little bit? So I think the main limitation on independence is you guys set the goals. That's so they don't have independence with respect to their objectives. That's set by the people's representatives. That's just independence about how they
Right. Well,
get
I
to
think
those.
this is where the rubber hits the road, because obviously we have political pressures that the Fed should not have. For example, the last time President Trump was President Trump, he clearly wanted to influence the Fed. I mean, I think we could all agree on that. He certainly said that about Mr. Powell. I mean, that's where I get concerned, and some of these executive orders get very close to that. Mr. Konzel, isn't that correct?
Yeah, absolutely. And the executive orders as currently stated, and obviously everyone's trying to figure out what's going to actually happen, but to the extent they can politicize the Federal Reserve functions of financial regulatory policy, many other things, I find that there's no way to have a strict wall and separation between the monetary policy and the regulatory policy. I do not think that works in practice. When I talk to people who have worked at the Federal Reserve, they agree that that's not a clear, separate room you can just put someone in. The supervisory functions seep into the monetary and open market policy discussions in a way that I think really risks the stability of our macroeconomy in a way that we're going to talk about a lot of different things here, but I really want to emphasize.
Yeah, so I do want to now move to the dual mandate. Now, one of the things that I heard today in testimony, I think it's true that most of the assets of the United States are held by very few people. Most people, most families, really deal with the economy with their job, their employment. And I think that's why it's so important to have the dual mandate, because again, this shouldn't be, the Fed shouldn't be for the very wealthy that control most of the assets. It should be for the economy of all the people. And most of the people, the way they interact with the economy is their job, employment. Could you comment a little bit about that?
Yeah, what I'd emphasize, and obviously we're going to talk about the 5-year review, there's many different central banks among peer and developed countries that have many different ways of trying to implement their policies. And so all of them saw the same inflation we saw. So the ECB is a very austere central bank. It has just a price stability mandate. Their inflation peaked at 10%, and it was rising even before Russia's invasion of Ukraine. You can go to New Zealand, which was one of the first inflation targeting banks. It has a reputation as having a particularly effective central bank. They use a range from 1% to 3%, which I think might be a very effective thing for us as well. And their inflation also peaked at 8%. So the dual mandate did not cause our inflation. What probably played an important role in was the huge labor market recovery we saw both in 2019 before COVID and over 2023 and 2024, where we have record high levels of labor force participation for women, for minorities, for people with disabilities.
This is where I reclaim my time, because I think one of the things that used to drive me crazy about Janet Yellen I think she's one of the smartest people who was here. And every time she was asked about inflation, she never put it in the wider context of the world. Instead, of course, my good colleagues on the other side would beat us up, and rightfully so, about inflation, because it was hurting our people. But she never put it in the context of the whole world. The EU was running much hotter than we were, and she never mentioned it once. Even though I have great respect for her, she sure blew it on that one. With that, I yield back.
The gentleman yields back. The gentleman from Arkansas, Mr. Hill, the full chairman of the committee, is recognized for 5 minutes.
Thanks, Chairman. Appreciate the panel. Great testimony. We're grateful for that. Dr. Michelle, you said that you think the Fed's trying to do too many things. I heard that, and Mr. Wang talked about that as well. Dr. Kohn, in your testimony, you say maximum employment is given by influences outside the control of the Fed, particularly the structure of the labor market. And then you say inflation is also subject to outside influences, but over time the Fed can control inflation. So would you say that of the so-called dual mandate, that price stability is certainly something the Fed has more direct influence over rather than quote-unquote full employment, which is severely impacted by regulatory policy, tax policy, spending policy, budget deficits? Is that true?
Yes, I think economists would agree that over time, inflation is, as Milton Friedman put it, everywhere and anywhere, a monetary phenomenon. That doesn't mean that the money supply directly feeds inflation, but the Federal Reserve can control inflation over longer periods of time. In terms of maximum employment, basically the level of maximum employment, the lowest possible unemployment rate, is inferred from the behavior of other variables around it. So if you push the unemployment rate...
But you're not arguing that you're a Phillips curve guy, are you, Dr. Kohn?
Yeah, I'm a Phillips curve guy.
Okay. All right, well, we'll have another visit about that. I think the last 50 years have discredited that economic thought. But you've been such an important voice in the Fed. We're glad to have you back before the committee. I heard you answer the question about the Fed's framework issue. What do you think would be the single most important thing that would go into that assessment about whether they missed it this time? I mean, I would argue I don't support setting 2% either under former Chair Yellen, because that means in 25 years, we're happy that we've lost 50% of our purchasing power. I mean, I think that, I mean, how can you argue for that as a public official? So what do you think when if you were sitting back in that meeting, what would be the most important point you'd make about having missed it in 2021?
So I think a lot of what what happened in 2021 was a bad forecast. And the Fed was not the only person making a forecast that inflation was going to come down over 2022 as these supply constraints, the supply chain stuff, remember the ships off of Long Beach and the chips and all that thing came off, people returned to work, then prices would come back down again. And that took much longer. And in addition, there was way too much pressure in the labor market. So it wasn't only supply constraints, there were demand constraints. But I think the bad forecast was a major reason why the Fed took so long. I think another reason was the forward guidance they gave on interest rates. So married with that forecast, they said, we're going to keep them at zero until we're back at full employment. So I think it all delayed it. Now, if the Fed had gone a few months earlier, would that have made a big difference? No, but it might have made a little difference. They would have gotten
I think,
started
I mean,
earlier.
certainly if you look, listen to Dr. Summers and other very prominent former officials in the Obama administration, for example, going in Q4 of 2020 and starting the shrinking of the balance sheet and slightly raising rates would have been potentially better. But I think you have bad monetary policy decisions, which we've talked about, but equally bad fiscal policy decisions, by the incoming administration at the time, the Biden administration.
I do think the Fed is to be...
Let me reclaim my time. I want to switch subjects. Thank you for that. Please respond in writing if you want to talk some more about that. Let me talk about the Fed balance sheet. Dr. Michelle, you were talking about the Fed allocating credit as one of those things that you thought was beyond strictly scope on price stability. So do you think that that's the case in buying mortgage-backed securities?
Oh, yeah, no doubt. I mean,
Should treasuries be the only open market asset for the Fed, for the Open Market Committee?
no, that would be my preference, yes. Short-term treasuries only.
And is there, what do you think, have you looked at the pernicious impact of, as was said in your testimony, too much gas on the fire for housing at the right of the time of the housing market was rebounding?
Yeah, no, that never made any sense at all.
Yeah. Would you give us some more background on that in writing, please? And with that, I yield back, Mr. Chairman.
Gentleman yields back. The gentleman from California, Mr. Sherman, who's also the ranking member of the Subcommittee on Capital Markets, is now recognized for 5 minutes.
Thank you, Mr. Wang, and I believe, Mr. Michel, you may be right that the Fed should only buy U.S. government paper rather than picking winners and losers in the economy. But I would argue that it shouldn't just be short-term paper. There are times when we have to drive down long-term interest rates, which I think are more significant for those making investments in housing and in factories, especially factories. And Mr. Michel, I got to strongly disagree with you on deflation, even gentle deflation, being a good thing. And if we're going to design things so that we may have gentle deflation, then we would have to realize that sometimes we would have ungentle inflation. You don't always get it right. I want to bring to the attention of this task force that a few hours ago, the SEC sent an email to its staff offering $50,000 to every staff member who will resign. Those resignations are required by March 21. They're available to the top 60%. This is no way to run an agency. It means you lose the best people, the ones who can, between now and March 21, line up a job on the outside. It means you have no control over which parts of your agency get smaller and which stay the same size. Your support personnel to line personnel gets radically changed because none of these buyouts were available to the bottom 40%. But most importantly, I oppose defunding the police, whether it's crime in the streets or crime in the suites. And when we offer $50,000 to every cop to quit, we get more crime in the streets. And I'll point out, this is all courtesy of Elon Musk, a man who has been investigated time and again for violating our securities laws, seems to have violated them even more on the issue of Dogecoin, and letting Al Capone set the size of the Chicago Police Department strikes me as a very bad idea. Let's talk about independence. Mr. Konzel, we have an independent Fed. Some countries don't. Turkey comes to mind as places where there is intense pressure. Has that worked out well for other countries to let politicians or even dictators tell their central bank what to do?
I would say no.
Couldn't agree with you more. Project 2025 has some ideas that are interesting, such as I said, limiting which kinds of bonds the Fed would buy and limiting the lender of last resort function. When we were crafting Dodd-Frank, I was a strong voice for trying to hem in the right of the Fed to bail out private entities. But the key thing that's being talked about is the dual mandate. Mr. Konzel, if we didn't have a dual mandate, so we told the Fed, don't care about unemployment, would we get more unemployment?
I believe so. I believe we probably would have caused an unnecessary recession to bring down the inflation that came down anyway. I think a lot of people at the margins of our labor force would be left behind under that kind of regime.
I'd like to focus on tariffs, but particularly their effect on housing. We need millions of new housing units built in this country. We now need to replace all the housing units in the Palisades and most of them in Altadena. The John Burns Research and Consulting folks say that the proposed White House tariffs will raise the cost of building structures in this country by 5%. Is that good for people who are looking to own a home?
No, I believe the cost of housing is already too high because of many things, including regulations, and I think the tariff regulation would be quite bad for housing.
And if another thing a little off to the side of the Fed, but part of 2025 is to, quote, privatize Fannie and Freddie. We had them privatized once where the taxpayers took all the risk and the private shareholders were supposed to make the profit. Should we go back to that, Mr. Konzel?
No, I think the old system was quite broken, and any system of deconservatorship would have to be done carefully and accountable.
And if
You know,
we
it's
just
not been
didn't
happening.
have Fannie and Freddie, could we give 30-year mortgages with 10% or 5% down payments to ordinary Americans?
No, I believe mortgage rates would be quite higher, even higher than they already are under Trump.
I yield back.
Gentleman yields back. The gentleman from Michigan, Mr. Huizinga, who also is Vice Chairman of the Full Committee, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and Dr. Kohn, good seeing you again. It has been a while. I was around first time you were in, but the Federal Reserve System, there's been a lot of talk about the dual mandate. It actually is focused on 3 key monetary policy objectives: maximum employment, price stability, and moderation of long-term interest rates. Somehow that seems to get sort of forgotten. I'm going to ask you a too high, too low, or about right for a response to this question. Are interest rates right now too high, too low, or about right? Dr. Kohn.
So I don't have a judgment on what,
Okay.
the right level,
All right, we're not,
embody people's
I
expectations.
don't have time for an explanation. Do you
Okay.
think they're about right?
They're about right for what people expect.
Okay. Mr. Wang.
Today, the 10-year yield is about 4%. I think that's about right.
Okay. Dr. Michel.
Sure. I have really no idea, and I don't think they do either.
Okay. Mr. Konzel.
They're slightly restrictive, which I think is appropriate given inflation right now.
So too low.
Slightly too high.
Too high. Slightly too high.
Appropriate,
Okay.
but higher than they
All
should
right.
be in the long run.
Great. So I wasn't here for the creation of Dodd-Frank 2010. I got elected in 2010, but I've been living with the echo effects of it ever since. I believe that today the Fed has even more power, more influence, and more control over our financial system than ever before, while improvements, as Dr. Kohn, you had said, have happened in transparency, partially because of the push that came out of this committee. It does, I believe, remain shrouded in mystery to most of the American people. And frankly, we're not talking about groundbreaking stuff right now. I mean, these are things that we talked about over a decade ago, and we were asking many of the same questions. How could the Fed be more transparent to Congress and the American people? How could they communicate its policy choices better, and then direct in the direction it was taking so that consumers and investors could make informed decisions about today and the future? Dr. Michel, let's start with you. You noted and cited a paper by economist John Taylor, one of my favorites, titled Monetary Policy Rules Work and Discretion Doesn't. As you know, Dr. Taylor became famous for the Taylor Rule, which essentially has a suggestion of guides how central banks could adjust interest rates to stabilize economic activity. I had suggested when Chair Yellen was in here that she could create the Yellen Rule. It didn't really matter what it was, but were there some rules that were published? Now, everybody says, well, we do this behind the scenes, but the problem is it's behind the scenes, and nobody really knows what they are doing. They're seeing a guessing game. So could you explain to the committee, Dr. Michel, how something like the Taylor Rule or the Yellen Rule or any other rule could have impacted the Fed's decision during the most recent economic downturn?
Sure. If we go by the standard, any of the standard rules really that are accepted by macroeconomists, then in that case, yes, rates are too restrictive at the moment. If they had been following a rule, at the very least, we would know what they're doing and why they're doing it. And by we, I mean you guys, Congress, and I think that's the most important thing. There's no way to judge how good or how badly they're doing because you don't really know what they're doing.
Okay.
And that's why a rule is important.
Would something like the Form Act,
Yes.
which had been a piece of my legislation, would that be a good starting point?
No, I think that's a perfect starting point because it provides what we call a flexible rule. They put a base rule in place, they can pick the rule that they like, and they can stick to it until they don't, as long as they explain to Congress what they're doing that's different and why.
I'm running out of time, so I'm having to jump around here a little bit. Obviously, the Fed now sets rates administratively, partly through interest on reserve balances, and there's significantly more reserves in the system now. I don't want to put words in Dr. Kohn's mouth, but it almost sounded like you said it doesn't really matter what the reserves are. And what I need to know, though, is has the Fed incentivized financial institutions to hoard reserves instead of putting capital to work for the real economy?
I think the liquidity regulations put a premium on holding liquidity, and they need to look carefully at that as to whether they're over-incentivizing holding liquidity. I don't think they are. It's important for financial stability. So I agree that there are adjustments, Mr. Wang said, to the leverage ratio that could be made that enable banks to intervene more aggressively in stabilizing the Treasury market, and that would be helpful. For example, exempting reserves from the leverage ratio.
Okay, but time has expired. We may be following up with some written questions. I yield back. Thank you.
Gentleman yields back. The chair now recognizes the gentlewoman from California, the ranking member of the full committee, Ms. Waters.
Thank you very much. Mr. Konzel, reporting has shown that American families are bracing for higher prices as consumer confidence fell drastically in February in response to Trump's actions as president so far. In my home state of California, a dozen eggs are going for $9 or more, and that's just the beginning. Families expect the price of housing, groceries, gas, and basic necessities to rise even further. This is especially true now that Trump said he would institute 25% import taxes on consumers and businesses buying goods from Canada and Mexico, and stock markets dropped in response. Given these trends, what are the Republican policies aimed at decreasing the cost of living? Under Republican leadership, can we only expect the cost of living to rise?
I think the policy on independent, I think the policy uncertainty about what's happening, for instance, I was off the grid last night, so I didn't know whether or not we were going to have a North American trade war. When I woke up this morning, apparently we do. That kind of policy uncertainty is very poor for investments, very poor for growth. And the emphasis on prices increasing at a period where consumers and everyday people are much more sensitive to prices than they may have been in decades, more recent decades, I do worry it will feed into inflation expectations, price increases, wage demands in a way that would be much more persistent than what we saw during the Biden administration.
But let me just ask you, this business of increasing the tariffs on our neighbors, will that absolutely increase the cost of living for Americans because there may be retaliation of some sort?
Very, very much so. I mean, that's kind of the point of the tariffs, to raise prices. We're already seeing auto prices going up over the last several months in anticipation of this, I believe, after having declined for, about 2 years beforehand. And, the way it particularly hits internal supply chains, because so many, like a car will go across the border so many times, I think it will be pretty complicated and very difficult for firms to do, even if there was clearer communications and a better process for implementing them.
Committee Democrats have many proposals to address the rising cost of living. We're fighting for legislation to grow the middle class, lower costs, and fight against wealthy corporations. I'm especially committed to addressing our nation's growing housing and homelessness crisis through bills like My Housing, Crisis Response Act, Ending Homelessness Act, and Down Payment Toward Equity Act. If Republicans will take up these bills and pass them, would Democratic policies lower Americans' housing costs?
I believe so. I believe there's, a real supply issue as well. But I do believe that getting more money into people's pockets will help, provide economic security. And crucially, finding ways to build the labor force, build the middle class, better health outcomes, better education outcomes, I think builds our labor force and our productivity and our ultimate growth.
Do you have any idea what percentage of the American public are paying 30% or more for rent, for example?
It would not shock me to be quite high, but I don't know, I'm sorry.
Do you believe that with the bills that I've just identified that we're passing, this would increase perhaps the ability to develop more housing, more affordable housing for people who are making lower incomes?
I believe so.
And so would you recommend that these bills be passed not only by Democrats, but by Republicans who are having tremendous problems in their own districts with people not being able to afford a decent cost of living?
I think housing is a serious concern for bipartisan support of major initiatives, yes.
Thank you very much, and I yield back.
Gentlelady yields back. The gentleman, I should say, from Kentucky, Mr. Barr, who's also chair of the Subcommittee on Financial Institutions, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Dr. Michelle, thank you for your lone dissenting voice in Leslie Stahl's biased and one-sided 60 Minutes report on DOGE's audit of the CFPB, which, as you know, is funded entirely from the Fed. In Ms. Stahl's critique of DOGE's access to personal private financial information, she failed to point out, and by the way, former Director Chopra also failed to point out, that the only reason why DOGE had access to that information is that the Bureau itself collected that information. So let me just ask you to correct the record for 60 minutes. Would DOGE have had access to personally identifiable financial information of Americans had the CFPB not collected it in the first place?
No.
No. Okay. So can you also inform the American public who maybe were misinformed by that 60 Minutes interview what happened with all of that personal financial information that the CFPB collected in I believe it was March of 2023? When the CFPB experienced a data breach?
They had a data breach, so, a lot of people got access to information that they shouldn't have had access to because that was collected in the first place.
Yeah, so what's the greater threat to Americans' financial data privacy, the CFPB or Doge?
Well, I did answer on that interview. I don't know that it got made the segment, but I said I have no greater concern that anybody in the administration now has access to that information than I did that the agency, the Bureau itself had. So I would say, yeah, my problem is that they have that information to begin with.
Yeah, exactly. So let me ask you this. Does the Fed's role in funding the CFPB politicize the Fed?
Absolutely. It should not be set up that way.
So if you're concerned about politicization of the Federal Reserve, why don't we, how about this, take the Bureau away from the Federal Reserve and subject it to the congressional appropriations process? You think that's a good idea?
Absolutely.
Yeah. Let's join in a bipartisan way, reassert Congress's appropriations authority, and actually depoliticize the Federal Reserve by taking the Bureau out of the Fed. Bank regulation. Mr. Wang, I want to ask you about the bank regulation's impact on monetary policy, specifically the way the SLR is currently calculated, disincentivizing banks from serving as intermediators in the primary, secondary, and repo markets for U.S. Treasury securities, decreasing liquidity in the Treasury markets. Mr. Wang, would an increase in market liquidity and stability help bring the long end of the yield curve down, which would in turn reduce mortgage rates and therefore reduce the cost of living for Americans?
I believe it would.
And does this give the Federal Reserve, would this give the Federal Reserve greater flexibility to lower the Fed funds rate and ease monetary policy?
Yes, it would.
So this is very important for all of us to remember. If you want to lower interest rates, if you want to lower inflation, the Fed needs to focus on deregulation. And especially with the SLR. Let me ask you about the balance sheet, and I'd like Dr. Kohn to weigh in on this. You know, shrinking the balance sheet on the one hand obviously pulls the money supply back, and from that standpoint might be disinflationary. But also shrinking the balance sheet decreases demand for treasuries, possibly pushing upward pressure on the 10-year. Is shrinking the balance sheet inflationary or disinflationary?
I would say it's disinflationary to a minor extent. For the reason you said, pulling it back probably puts a little bit of upward pressure on that 10-year.
Okay. Let me ask a final question. A lot of conversation about the 50 basis point cut in September. Certainly, even if Chairman Powell is right that they're not focused on politics, the perception was really bad. It was a bad look 2 months before a major election to cut that aggressively 50 basis points, in my view. And was this a mistake? Because even though the federal funds rate was cut aggressively, you still had an increase in the 10-year at the same time. Anyone?
So I don't think the increase in the 10-year reflected the cut in the federal funds rate. There was very little increase in inflation expectations as measured in the market. It was mostly term premium over the next few months, and that's about uncertainty, and uncertainty created by the election, by financial and economic developments. So it wasn't really about the cut in the funds rate.
Well, obviously the 30-year fixed rate mortgage shot up.
Right.
Despite the rate cut. And
Gentleman's time has
inflation's
expired.
still a
I would
problem.
also flag that summer we had breached the SOM rule, so many people were quite worried about an incoming recession, and rates were quite restrictive at that point. So the 50
Gentleman's
basis-
time has expired. The chair now
Thank you. Yield
recognizes
back.
the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you. I just note that Mr. Barr's support for giving unvetted personnel access to the Treasury payment system with unsecured devices, hacking in not only U.S. taxpayers' information, but other information held by the Treasury, is neither patriotic nor is supported by the full committee. I want to ask a really dumb question first, and this is not a gotcha question. Does anybody disagree with the statement that price increases are inflationary? I see, okay. So we agree that the tariff policy that Donald Trump is imposing to raise prices on imported goods is inflationary. I am sure we may have differences, we certainly have differences up here about the fiscal consequences of that. But it raises questions about what happens when the fiscal policy of the United States is at odds with the monetary policy of the Fed. One is trying to bring down inflation, one is actively working to bring it up. The 1890s show an example of what happens. I would rather not make America great again back in that time period, even though a lot of the White House seems to support what life was like in the 1890s. But for us to manage that, we are going to have to keep an eye on the data in the system. Do all of you support, as Chairman Powell indicated when he was a few weeks ago, that we have to make sure that data at the Bureau of Economic Analysis and the Bureau of Labor Statistics stays pure, stays accurate, stays untouched by political appointees trying to change that data?
Well, I think the accuracy and the purity of that data are absolute, and the credibility of that data are absolutely essential. Can I make a distinction between price increases?
Well, I want to just move on because I want to get to another point that is not as partisan, and I think more supported, but I appreciate you saying that, because when Donald Trump is saying that he wants to go in and put Schedule F employees, get rid of them, make this political, there's bad things that happen. I want to shift to a different issue. I've heard concerns from a number of people who I trust about the surging volumes of dollar-denominated deposits in non-U.S. banks. And specifically that, and I have a hard time getting data that's all, some of this, the data gets a little stale, but in 2021, global banks were holding over $15 trillion in dollar-denominated deposits. First quarter of 2023, it broke a streak of 3 consecutive contractions. It was an increase of $326 billion of US dollar deposits in foreign banks. And so I guess, Dr. Kohn, given your work on the Federal Reserve Board, is that consistent with what you're seeing, that we're seeing increased dollar deposits in non-U.S. banks?
I don't know anything about that.
Okay. Have any of you seen this data or heard the concern before? Okay. The issue that's been raised to me by several folks is that there's a consistent bipartisan push at Treasury to have a strong dollar because it lowers our borrowing costs. That in turn makes the dollar very attractive for remittances. It makes the dollar very attractive, it makes our exports stronger. And if we have increased dollar deposits at U.S. banks, the FDIC doesn't regulate those banks. And so if there is a run on those dollars, there's a macroeconomic concern. And BIS recently noted that global banks are turning to increasingly flighty funding services to secure those. In the first half of 2023, dollar funding by money market funds to global banks went up by 53%, and most of that came in the form of repos. So I guess, Mr. Konzel, I'll start with you. Are there any hidden risks sitting out there in the repo market, and should we be concerned about any broader contagion if there's a run on those dollars?
I don't know enough to comment. I apologize.
Anybody have any intel into that?
So I was a repo trader on the Federal Reserve. The repo loans are secured by Treasury collateral, so they are very safe. In the past, a lot of banks traded unsecured. There was credit risk then, but today it's a much more stable form of financing.
But I guess like the security of money market funds makes sense when we're looking in our own borders. And the concern I have is like, what happens if we have large volumes? I mean, maybe if any just want to answer academically, if you're not familiar with the immediate data, if you have large growing volumes of dollar deposits that are outside the FDIC system, and those are being backed by money market funds, should we be concerned about that? Like it seems like with all of the checks we have internal to our economy, we know how to regulate those because our banks are regulated in the US. What happens if you've got huge numbers of dollar deposits at the Bank of China?
Historically, what happens if we have dollar disturbances abroad is the Federal Reserve has foreign swap lines, FX swap lines, where they will lend to foreign central banks who in turn can support the dollar deposits in foreign jurisdictions.
But doesn't that then create an issue where like our foreign adversaries could potentially be creating a run that we would have to step in and backstop with taxpayer money?
That is possible depending on the jurisdiction. Not all jurisdictions have swap lines.
Yeah, I do think it's important for the authorities in the U.S. and globally to look for spots, examples of things that might become unstable because of runs. I don't know whether this is that you've actually spotted one or not. But
I'm getting the tap. I don't know that there is a run, it's a concern, and if you learn more, I'd love to chat with you. And I
Gentleman's
yield
time
back.
has expired. The gentleman from Nebraska, Mr. Flood, who's also chairman of the Subcommittee on Housing and Insurance, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning, everyone. I, too, have been concerned about the size of the Federal Reserve's balance sheet. Quantitative easing is a monetary policy tool that is less than 2 decades old, and it's already led the Federal Reserve to carry a significant balance over the last decade. Today, the Federal Reserve's balance sheet remains at more than $6.7 trillion of assets, despite recent efforts at quantitative tightening. My concern is that with a pattern of quantitative easing over the next couple of years, I feel that we'll see the Fed's balance sheet grow much faster in bad economic times than it will shrink when the Fed moves to quantitative tightening during the good times. In this scenario, we could see the Fed's balance sheet grow larger and larger and larger over time. I'd like each one of our panelists to comment on this concern that I have. And here's the question. Do you feel that it's misplaced, or do you think that there's reason to have concern about the possibility of what I'm talking about? Dr. Kohn, let's start with you.
So I think the balance sheet would grow only if interest rates were already at zero and there were a threat to the U.S. economy. So I'm glad that the Federal Reserve has the authority and would make the decision to grow the balance sheet in order to lower interest rates and stimulate spendings at time of weakness. So I'm not particularly concerned about that.
Thank you. Mr. Wang?
So under current banking regulations, banks are required to hold lots of liquid assets, among them reserves. And so in a sense, in order for banks to meet those requirements, we would expect the Federal Reserve to gradually grow its balance sheet, maybe not at the same rate as it does during emergencies, but over time, simply to produce liquidity for the banks to hold.
Thank you. Dr. Michel?
Yes, so especially if anything else happens, any other emergency situation, not necessarily as bad as the COVID crisis, but the runoff is so slow, as it was the first time, that it's more likely to increase than decrease in the long run, I think, for now.
Thank you. Mr. Konzel?
I think there's a very big academic debate about whether or not we are still in so-called secular stagnation or in a period of very low interest rates in normal times. If we are still in that world, it would probably expand again in the next recession. But if we're not, and the Federal Reserve has enough leeway with its interest rate policy to manage a business cycle, then not. So my assumption is baseline probably declining.
Okay, so now that the Federal Reserve has amassed such a large balance sheet, one concern is that quantitative tightening too quickly could lead to instability in the market for Treasury securities. Here's the question. If we're unable to unwind quantitative easing measures in a timely manner due to concern with the Treasury market, does that raise questions about how viable quantitative easing is as a long-term sustainable monetary policy tool? Dr. Kohn, let's start with you.
I think that I would answer that question the way I answered the previous one. I think they can still go out and buy more securities if they need to under the circumstances. There's really no relationship between the size of the balance sheet and inflation. I know that people worried about that in the 20-teens. People from this committee, I had conversations with staff on this committee. The balance sheet is blowing up, we're going to have inflation. Didn't happen until the COVID thing, right? So I think I don't worry about the size of the balance sheet relative to inflation, for example.
Thank you. I'd like to pivot to Federal Reserve's Emergency Liquidity 13.3 authority. Dodd-Frank made some changes to Section 13.3, and in the economic downturn accompanying the onset of COVID-19's pandemic, we saw the Federal Reserve use this revised authority for the first time in its new form with Treasury. Mr. Wang, what lessons can we learn from how the Federal Reserve used Section 13.3 facilities during 2020, and how should we in Congress be thinking about this authority moving forward?
So when I take a step back and look, it seems like these 13.3 facilities are growing in their extent. We saw them come out during the great financial crisis to help money market funds, asset-backed commercial paper. This time around in 2020, they also helped corporate credit, mainstream lending facilities. It seems that they keep growing, and the Fed is in effect being the lender of last resort to everyone in the economy. So I think it's worth thinking about if that's the design of the Fed, if that is in agreement with the wishes of Congress.
Thank you, Mr. Wang, and thank you, Mr. Chairman, for chairing today's committee, and with that, I yield back.
Gentleman yields back. The chair recognizes the gentleman from Louisiana, Mr. Fields, for 5 minutes.
Thank you, Mr. Chairman, for having this hearing, and also the ranking member. And I also want to thank the witnesses for being here. I only have 3 questions, and I'm going to direct all 3 of them to Mr. Konzel. First, the Trump administration plan to shut down the Consumer Protection Bureau could lead to many consumers to financial exploitation, including predatory lending and overdraft fees. Could the absence of strong consumer protection contribute to the economic instability or financial distress for the working class?
Yes, I believe so.
And the Trump administration also has openly pressured the feds into to cut rates. And while Chairman Powell has consistently said that he has resisted those pressures, and he has, do you believe that the Fed is facing greater risks of political influence today than previous administrations?
Yes, I believe the attack on the independence of the independent agencies, including the Federal Reserve, is, we haven't seen that kind of risk in a long time. And I think the way that they are trying, the Trump administration is trying to thread a needle where they're saying the Fed won't be independent except for monetary policy is unstable. The people I talk to who would know the Federal Reserve and nonpartisan analysts believe that that's not really a stable arrangement and that the whole institution, including monetary policy, will be politicized under this administration.
And my last question is that there are reports that the feds have recently removed public diversity and inclusion data from its website, following the Trump administration, in my opinion, unlawful order to eliminate DEI programs. Do you see this as a concerning trend, and how could we reduce transparency in the workplace and have an impact on financial policy making?
So this is not my world, but I do know many experts are worried not just about this or that initiative, but a more wholesale attack on civil rights law in this country. We saw with some of the executive orders that came out. Financial inclusion is quite important. It's a huge priority for administrations. And you see things about research being pulled because it's looking into, say, the way credit or other things impact different populations. I think not being able to research that or address that would leave many Americans behind.
All right, thank you, Mr. Chairman. I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Mr. Chair, and the witnesses, the panel. Thank you so much for your time and being here today. I'm going to start out a little on transitory inflation. Dr. Kohn, the Biden administration and the Federal Reserve spent most of 2021 assuring the American people that the inflation they were seeing was merely transitory and that no action was needed. What followed was the worst rate of inflation since the early 1980s when the Federal Reserve finally changed course. But inflation hits rural areas like Montana's 2nd District that I represent the hardest. So how did the Federal Reserve get this wrong for so long?
I think, first of all, the Federal Reserve was not alone in getting it wrong. Most economists had it wrong. So if you look at surveys of economists, they had that wrong. Secondly, I think we need to recognize how unique and unusual this situation was. Once a century, the global economy closes down because of a pandemic, right? So 1918 and last time. So there's really no precedent. How to analyze this, what's going on, how soon it's going to unwind is very, very difficult. And thirdly, I think to the Fed's credit, they recognized they made a mistake and they tightened quite substantially in 2021. And they would be the first to tell you, no, we should have gone a little earlier. If we knew now, if we had good foresight, we would have gone earlier. But it was a very difficult situation to separate the supply effects, when they were going to run off, versus the demand effects and tightening policy.
Yeah, thank you. Switching here a little bit, this is Mr. Wang. The United States now exceeds $36 trillion in debt. That's over $100,000 per person. Staggering. The United States pays more on its interest than it does on national defense every year. And at our current pace, the interest on our debt will be the second largest U.S. expenditure by 2035 after Social Security. Chairman Powell has repeatedly stated our national debt is on an unsustainable path. So what does an actual debt crisis look like, and how much longer can the U.S. stay on this debt path?
I think in the case of the United States, we are special in that we can print our own currency. And so in that sense, we can always afford our debts. But there are macroeconomic consequences to this, where that could be ultimately place upward pressure on inflation.
Thank you. Switching again, this is for Dr. Michel, and I know that Chairman Hill asked a similar question to Dr. Kohn, but I'm going to try to rephrase, and I'd love to hear yours. The Federal Reserve has a dual mandate of stabilizing prices and maximizing employment. We also know an economy that's too hot is likely to suffer from high inflation, and the Federal Reserve has had to react to the trillions of dollars in spending from congressional Democrats during the 117th Congress by raising interest rates. And, I noticed in your opening remarks that you said, Congress gives the Fed too much to do and too much discretionary authority. But my question to you is, would the Federal Reserve be more effective if its sole mandate was to achieve stable prices?
Yes, no, I believe it would. You would be giving it something to do that it could actually control and that it could actually directly affect, as opposed to something that's nebulous and very difficult to define, much less control.
Thank you. Dr. Kohn, back to you. During the first 2 years of the Biden administration, congressional Democrats spent trillions of dollars in economic stimulus despite early warning signs of inflation. Does this sort of unprecedented spending make the Federal Reserve's job of combating inflation more difficult?
So I think the Fed still had the tools to combat inflation. I think what disappointed me a bit was that they took so long to use them, and they should have seen the demand-enhancing effects of those spending, and that should have sent their antennas quivering perhaps a bit faster on that inflation. So the Fed could have fought the inflation, but there was difficulty analyzing it and difficulty figuring out when to move.
Right. Well, I thank you for your answers, and unfortunately, I've run out of time, so Mr. Chair, I yield.
Gentleman yields back to the chair. Now recognize the gentleman from Oregon, Ms. Bynum, for 5 minutes.
Thank you, Mr. Chair, and thank you to our witnesses today. The first question I have is I'm a mom. I've got 4 kids. 2 of them are college age. I love them. I want them to live in our community, but it doesn't feel like there's a whole lot of hope for our kids moving out of our homes these days. And so I wanted to ask if any of you knew the average age of the first-time home buyer and whether we should be concerned. I believe
it's risen up to 32?
38 was what I was told.
38, okay. I believe and it's in the 30s now, which is higher than it had been, yes. If you were asking me if I'm concerned about that, no.
Would you elaborate?
Well, I don't think that the policy that the U.S. Congress implements or that the federal government implements should be directed at picking a particular age for the first-time home buyer. And I think that the reason that the age has gone up is a whole set of circumstances, some of which they can't control. And I don't think that should be the goal anyway, so.
A lot of this is a response to constriction on local supply. So I think a lot of this has to do with our local communities and the zoning laws, and we need to increase the supply of houses, and that would make it more affordable. But a lot of that is just state and local regulation.
That's very helpful, thank you. Mr. Konzel, so rising mortgage rates have made it much harder for first-time home buyers to afford a home, and so many existing homeowners are locked into low rates, limiting our housing supply, some of which was just alluded to. So given that monetary policy plays a role in interest rates but isn't the only factor in housing costs, what policy solutions do you think could complement the Fed's efforts to ensure affordability without increasing inflationary pressures?
Estimates vary, but I think associations believe there's somewhere between 3 and 6 million too few homes. So policies that allow us to build homes faster and cheaper. More generally, productivity and construction and housing has lagged quite a bit over the last few decades. I think there's been a lot of research trying to figure out why. But as Dr. Kohn mentioned, local constraints seem to play a role in that. I will say efforts to boost income security for young families is quite important. I look at the monthly child tax credit that was fully refundable, that was passed as part of the American Rescue Plan, which cut child poverty in half. I think was an incredibly good investment in families and community. And then that investment in children and families pays off dividends decades later as better health outcomes, better education outcomes, and better outcomes for everyone.
Thank you. My second question on that is, we know that increasing the housing supply is critical to long-term affordability, but the higher borrowing costs have made it more expensive for developers to build new homes. So how do we ensure that efforts to curb inflation don't worsen the housing shortage and make affordability even harder in years to come?
That was an irony and a difficult part of the recovery was that, one place where we knew higher and restrictive interest rates were particularly binding was on the housing market, which slowed quite dramatically after having picked up. That said, the housing deficit is a longer-term problem. It certainly comes from the aftermath of the financial crisis and the large wave of foreclosures that happened after that, and the much lower rate of housing building that happened following that. So, that was something the Federal Reserve obviously took into account. The fact that the way housing inflation was measured was quite high, but they were also restricting the supply of new housing. But that was a more temporary and short-term problem. As rates normalize, hopefully we can see home building pick up and we can find ways to make home construction productivity even better.
Thank you. Mr. Chair, I'd just like to put on the record, I am very concerned that our young people, based on the testimony of the witnesses here today, can't really look forward to being able to purchase a home in the next 10 years if they're just graduating college at about 22. I mean, I think that's what you're seeing as an uprising in this country, and that's really challenging for me. So maybe it's on policymakers, and maybe what you all are suggesting, it's not on the Fed, but it's on policymakers to make that a reality for our young people. So
Gentlemen, gentle ladies duly noted. Statements, comments duly noted.
thank you. I yield back.
And gentle lady yields back. The chair now turns to the gentleman from Indiana, Mr. Stutzman, for 5 minutes.
Thank you, Mr. Chairman, and thank you, gentlemen, for being here today and for your comments. I'd like to go to Dr. Michelle and then would also invite any other comments from the panel as well. But as we know, the Federal Reserve is mandated by Congress to ensure price stability and promote maximum employment. But it was only in 2012 that the Fed publicly made it known that it had a 2% inflation target. Dr. Michelle, your testimony describes some of the reasons the Fed has used to justify the 2% target. And practically speaking, what does it mean to target a constantly positive rate of inflation? Is it fair to think about it as debasing the value of the dollar by 2% a year? I think there's a lot of focus on this 2% inflation number. I'd like to hear your comments on that.
That's fair. That's an accurate way of looking at it. The most common sort of reason given is that the Fed needs to keep inflation going so that the economy keeps moving, sort of a grease the wheels thing, and motive rather. And there's a lot of academic research that suggests that that's not really the way that works. And if you do have a growing economy, an increasing supply, everything else constant, you should see prices come down. There's more goods and services available. they should become less expensive. We prevent that from happening. And I don't solely blame the Fed, because there is a fiscal component, a spending component to that. But in conjunction, I do blame federal policy, partly on the Fed side, for trying to ensure that the price level never falls. And contrary to what Mr. Sherman believes, it is perfectly okay, and it has been historically, to have a gently falling price level. It does not mean that there's a calamity. There's a huge difference between a collapse in asset prices and a gently falling price level.
Yeah.
And the latter is not a bad thing, it's a good thing.
I mean, supply and demand dictates price levels to a point, but it feels like we're also trying to manipulate the market to hit this 2% number. Mr. Wang, would you want to comment, or you're shaking your head there like you're...
No, I agree. So the 2% target is something the Fed has set itself, whereas the mandate given by Congress is price stability. It seems like that could be defined by Congress if it were of their choosing.
Yeah.
So I like the definitions that Chairman Volker and Greenspan gave to price stability. That is, inflation low enough that people don't have to take account of it in their everyday activities. And I think we have a lot of evidence that 2% reaches that. No one was talking about inflation when inflation was 2 or just a little under through the teens, or 2 in the early 2000s. So I think, and another, I mean, Dr. Michelle is right that one of the reasons that people favor a little bit of inflation is it greases the wheels of the, and I have some empirical studies that I can counter him with, but I think another reason is the level of nominal interest rates. So expected inflation gets built into nominal rates. If nominal rates are already at 1 or 0 and something bad happens to the economy, there's very little the Fed can do to lower interest rates, and it'll be forced into buying securities. So keeping nominal rates high enough to embody that 2% inflation and a 1 or 2% real rate, 4% means in equilibrium, and then something bad happens, then the Fed has 4 percentage points to lower interest rates to stimulate the economy without resorting to QE.
I mean, I know my district, I want to come to you, Mr. Konzel. I know my district's full of small businesses, manufacturing, agriculture, and, to anticipate, these marks is sometimes difficult. It's more important to look at where you're at in the business and where do you believe you can make profits. Mr. Konzel, would you?
I was just going to amplify, the committee seems very concerned about the level of balance sheet, and, that is something that people, wonder about. But if we were trying to target 0% inflation, the balance sheet would be much more volatile, because that would basically be the only tool you have.
So you think the 2% target is the right target?
I personally prefer a 1 to 3% target. It has served New Zealand and many other countries that have really fantastic macroeconomic concerns. I think the point target is a little hard and gets into this averaging question that the Fed is currently doing. There's actually a wide variety, and I think it would be a great thing for the task force to study.
All right, Mr. Chairman, I'll yield back the balance of my time, but I do think supply and demand economics is critical for our country to be really successful.
Gentleman yields back. The chair now recognizes the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Chairman. Thank you, gentlemen, for being here. So Jason Furman, I think whose name came up earlier, was President Biden's top economist at the CEA. And he recently published a lengthy op-ed admitting that Bidenomics was a failure. His arguments, or what he argued, was I think a lot of Democrats were kind of in denial of this, but the inflation was principally caused by too much government spending. And I know there were numerous bills and that were rolled through while I was a member, the last couple of Congresses, and not just the global shock of the supply chains, right? So, and yet when I read Mr. Konzel, your written testimony, you don't acknowledge that the government spending led to the inflationary increases at all. So I'd just like to hear your response on that, because I think it's important as we look back on what happened now, what is the case by those that say that that did not happen? I don't want to put words in your mouth, so if you could
Absolutely,
respond.
I'm very familiar with Jason's article. You know, to me, it's an argument from 2022. Jason Furman at that point argued you would need a mild recession to get inflation below 4% and a severe recession to get inflation below 3%. Right now, inflation is about 2.5%. Still a little higher than we'd like it, but with a period of growth that was above trend and unemployment below 4% on average. So I think that argument, which is what the argument is of the piece, there's a lot of different arguments about how much the ARP, the American Rescue Plan, may have contributed. Prices rose about 21% under President Biden's 4 years. Normally, they would have risen about 8%. I've seen some arguments that maybe about 2% of that could have been attributed to fiscal stimulus. So, you know, would 19% instead of 21% prices really have changed the needle for everyday families? Probably not. And the income security that came, particularly through the child tax credit and many other things, helped stabilize balance sheets that I believe gave us the best recovery following the invasion. You know, you can look at blue chip forecasts, as was brought up before, this private, nonpartisan. You know, even after the American Rescue Plan passed, you know, the highest estimate in blue chip for inflation in 2022 was 3.2%. The actual number was 8%. I think the shocks of the reopening, the shocks of huge changes and demand, and, you know, as a reminder, the unprovoked invasion of Ukraine by Russia really threw commodity markets into turmoil, which, you know, in the long run, those relative prices don't matter, but in the short term, you know, the price of goods skyrocket, but the price of services do not fall. And that increases overall inflation, and services come back online into a higher price level. So, you know, we can argue at the margins how much of a difference it made, but the idea that it was the primary driver of an inflation that was global and was seen by other peer countries, I just don't think the evidence is there.
So, Dr. Michelle, wasn't inflation the result of not just supply-side shocks related to the pandemic, but just too much government spending? I mean,
Yes, it definitely was a cause, one of the causes for sure, and that it did occur globally, by the way. We're not the only country that did a lot of government spending, so we're not unique in that regard either.
Well, Mr. Kohn, let me just kind of switch topics real quick. Recent economic data indicates long-term interest rates have disconnected from the Fed's expectations. With 10-year rates now about 40 basis points higher than what the Fed expected, I think. Do you think that was predictable, or do you feel like everything that's happened, you know, we've had the chairman before the committee numerous times, the full committee. Where do you think we are right now?
I think there have been a couple of different contributors to the rise in long-term rates. One is that because the economy was so strong in the fourth quarter and coming into the first quarter, and financial markets were so ebullient, people took out some easing that they had built into the Fed policy. So they thought the economy was going to be weaker, Fed policy was restrictive, Fed was going to have to cut interest rates by more. Now they put a little more back in there, but the Fed itself and the market saw less need for easing. So it wasn't a question the Fed would need to raise rates, but it would be easing less. Secondly, there's a little bit of extra inflation in there, partly because of the concerns about the tariffs and what that would do to the price level, near-term inflation. And third, a lot of it is the so-called term premium, the stuff we can't attribute to expected policy or inflation. It's uncertainty about what's coming next. The fact that if you're holding a long-term security, you're taking risks because the price of those securities go up and down. You need to be compensated for risk, and you have concerns about the risk. Some of it could be the fiscal trajectory that we've been talking about, the unsustainable fiscal trajectory, and few hints that it'll change anytime soon. So I think there are a bunch of different reasons for that basis point increase in the 10-year rate.
Thank you. Mr. Chairman, before I yield back, can I ask unanimous consent to insert Jason Furman's op-ed titled "The Post-Neoliberal Delusion and the Tragedy of Bidenomics" into the record?
Seeing no objections, so ordered, and the gentleman's time has expired. I would like to thank all of our witnesses for the testimony, and simply to note, as we would say back home, monetary policy is a chess game. It's not checkers, is it, gentlemen? Without objection, all members will have 5 legislative days to submit additional written questions for the witnesses. to the chair. The questions will be forwarded to the witnesses for their response. Witnesses, please respond no later than April 30, 2025. This hearing is adjourned.